Hello, everyone, and thank you for joining us today for the second in a two-part webinar series to discuss one of the most important aspects of impact investing, impact measurement and management, or IMM. The first webinar last week focused on key choices in IMM, geared towards investors designing an IMM practice. And this will really follow on from that and delve deeper into some of the approaches to common challenges in IMM. We'll talk about progress the industry's made in advancing the practice, where there may still be work to be done, and pathways forward to continue strengthening the field. So first, a couple housekeeping items. You're all on mute, but we encourage you to actively participate and submit questions or comments, which you do via the chat function in the lower left corner of your screen. You can do this at any point throughout the hour, and we'll have dedicated Q&A at the end. Also, the webinar will be recorded, and we'll circulate that along with the slides afterwards. So to get you all thinking, and also to see who's on the line, we'll have you answer a quick poll about your impact orientation or how you're seeking to create impact through your investments. So please go ahead and fill that out. It should be multi-select. And while you do that, I'll just share our agenda for the hour. So first, we'll share some findings from our recently published research on IMM in impact investing. Then we'll hear about some emerging resources available to help strengthen your practice. Then we will hear from two seasoned practitioners about their experiences, Will Morgan with Sonen Capital and Michael Etzel with the Bridgespan Group. And then lastly, of course, we'll have time for questions. So again, please submit them throughout the hour in the lower left corner of your screen. Great, so we have some results coming in. And that's great to see that we have folks coming from a range of impact orientations. Many of you are using more intentional strategies to create impact, as well as investing in sustainable companies, using some negative screening approaches. So that's wonderful, some diverse perspectives on the line. Alrighty, so first I'll turn it over to my colleague Kelly McCarthy, the GIIN's Director of IRIS and Impact Measurement and Management, to share a couple opening words.
Thanks, Anna, and thanks everyone on the line for joining us today. And I also just want to thank in advance our speakers for so thoughtfully situating the findings of this report in the day-to-day work of impact investing. The Global Impact Investing Network, or the GIIN, is a nonprofit organization dedicated to increasing the scale and effectiveness of impact investing around the world. We do so through our work with investors, through our membership, by offering training, and by providing critical research and infrastructure to support the practice of impact investing. Impact investments are investments made into companies, organizations, and funds with the intention to generate measurable social and environmental impact alongside a financial return. My name is Kelly McCarthy, as Hannah mentioned, and I lead the GIIN's work to develop resources and tools to support investor impact measurement and management. So why this report and this conversation today? Why is this important? Impact investing has two clear objectives: to create a positive social and environmental impact and to generate a financial return. As investors, we are comfortable understanding financial performance, but how do we understand social and environmental performance? How do we understand what is good, what is better, what is best? How do we incorporate that understanding into investment decisions alongside risk, return, liquidity, and other factors? How do we know whether or not our investment dollars are contributing to social and environmental good? The answer, I think, as we all are grappling with this on the line, isn't cut and dry. Yet, as this report demonstrates, for impact investors and the market-building institutions that support this growing industry, figuring out how to measure, understand, and manage the social and environmental good that's created by a given investment is more important now than ever to making effective impact investments. In the next 30 minutes or so, we hope to provide you with a deeper understanding of the trends affecting impact measurement and management practices. And through our conversation with Sonen and Bridgespan, we also hope to shed light on two things: how leading impact investors are tackling some of the pervasive barriers affecting our ability to fully integrate impact into investment management alongside financial factors, and what the developments and progress points highlighted in this report might mean as we look ahead to the growth and development of impact investing. So without further ado, I'll turn it back over to my colleague Hannah, one of the authors of the State of Impact Measurement and Management. During her remarks, I encourage you all to think about a few things: what it means for us to progress on some of the data points she'll highlight, what trends might the progress or the barriers indicate, and what are the implications of an action on some of the pervasive barriers. So with that, Hannah, I'll turn it over to you.
Great, thank you, Kelly. Wonderful. So just a reminder to submit any questions that you have throughout the hour, and we'll be taking those at the end. So I'm excited to present findings from the first edition of the GIIN's Impact Measurement and Management, or IMM, survey, which is the first comprehensive research on IMM practices in impact investing. And it really represents quite a critical moment for the industry. Impact measurement and management, of course, is central to the definition of impact investing, and therefore to your strategies and practices, as those of you on the line. Yet there had been very little research to date on the landscape of activities and approaches to IMM. But with this data, we can really draw better insight into the options that exist, as well as opportunities to advance industry practice. So we produced this report with generous support from the Rockefeller Foundation, and altogether generated responses from 169 investors around the world, impact investors. And to those of you on the line who contributed, thank you. And also to those of you looking to be involved in GIIN research, there are many opportunities, like our annual Impact Investor Survey, for which data collection is now open. So please do get in touch with me if you'd like to participate. So we'll cover a few important points from the report today, but the full piece includes data on many additional topics, like why impact investors measure and manage impact, how they do so, some of the tactics, strategies, and approaches to ensure accountability to achieving impact goals, and perspectives on where the market's progressed and where it should go. So I encourage you all to look at the full report on the GIIN's Knowledge Center. So it's worth setting the scene and going over why impact investors measure and manage impact. We see that the top motivations driving IMM are that impact is, of course, central to impact investors' activities. So they engage in IMM both to understand the impact they're having, but also to change their practices and really help drive or improve their impact. The data also show us that while historically maybe we thought of IMM as perhaps something done to report to stakeholders or to meet other compliance requirements, we really see a shift to IMM being thought of much more as a business tool. Interestingly, over 60% of respondents note that they find impact data have business value, as you can see in that third box. On the contrary, on the right side there, you see fewer kind of external incentives to measure and manage impact, such as client demand or cultural norms or requirements from government regulations. So we'll talk about some of the main challenges respondents face at their own organizations in conducting IMM, that some of you may, of course, be familiar with. And then we'll use these to kind of anchor our conversation and go over some approaches to these challenges and what the data tells us. So the top challenge lies in collecting quality data, analyzing and aggregating data across a portfolio, and in selecting appropriate impact metrics and targets. And I'll also note that on the right, you see a few respondents said it was a challenge to ensure buy-in for IMM among key decision makers at their organizations. So again, I think this shows the growing recognition of the value of IMM. So again, we'll use these to anchor our conversation and now explore some of the practices and strategies investors are using to overcome these. So the first we'll look at is in collecting quality data. So we'll start with what data investors are actually collecting. So we asked respondents which types of impact they measure. As you can see at the top, most measure outputs, but it's also good to see that most also do measure outcomes. And it's also quite positive to see that many investors also measure other kind of nuanced and potentially more resource-intensive aspects of impact, like breadth or the reach of their work across groups of people, additionality, or whether impact would have occurred anyway without their investment, the depth or significance of their impact, and attribution. And investors use many different frameworks, tools, standards, and other resources to conduct IMM. This chart, I think the main takeaway is it shows the wide variety. Some of the top include IRIS, or the GIIN's catalog of over 500 social, environmental, and financial performance metrics. The UN SDGs and GIIRs are also commonly used, as well as some of these other kind of more sector-specific tools or resources. So the second challenge noted is in aggregating impact data across the portfolio. And one way we can look at this is the extent to which investors customize or standardize metrics across their portfolio. About 20% of investors do use fairly bespoke metrics to customize them to each sector impact theme or even to each investment. Oops. Sorry about that lag. Here we go. And then you see that a quarter use standard metrics across their portfolio. We were working from the right to the left. And then about a third or over a third do some combination of these two. So again, this shows one way that investors are kind of approaching the challenge of conducting IMM across a diverse portfolio. The third challenge we'll touch on is how investors select impact targets and metrics. So we see that most investors really, we see here that about 60% of investors set impact targets, although I'll note that there are diverse kind of perspectives regarding impact targets and whether or how to incorporate them, really depending on an investor's strategy and approach. So we asked investors how they set impact targets and metrics. And we see that most really base these decisions off of evidence, or the same evidence that they use to develop their strategy in the first place. And many select them using established tools or indices, for example, like IRIS. So again, this reinforces, one way investors have developed some approaches to the process of selecting targets and metrics. And then lastly, I'll talk about what impact investors do with this data. So this is helpful to look at, both in making the case not only that impact data are useful, but how they're useful and how they relate to investment management. So we see that impact data really inform key investment decisions. They're used in pre-screening or due diligence, as you see on the left there, investment selection, and other kind of critical portfolio allocation decisions. So I think this reinforces some of those indicators that IMM is not, a siloed off as a separate activity, but is seen as integral to some of these broader financial and investment management decisions. And then, of course, impact data is used both to measure and communicate impact to stakeholders, but also to manage impact, to refine metrics, or the way data is analyzed, and to use that to manage towards greater impact. So I've shared some ways investors approach IMM on a practitioner level. And lastly, I'll share what this report has told us about what we see in terms of industry-wide progress and opportunities. So we all know, of course, that IMM has evolved significantly over the past several years. So we asked respondents to share their views on progress in IMM and any remaining challenges. So on the right, you see the respondents generally reported some progress on most indicators. 20% or more noted progress on investor or donor understanding of IMM practice, sophistication of IMM tools and frameworks, addressing ESG risk, research and data on IMM practice, and professionals with IMM relevant skill sets. And then you also see on the left that some indicators do remain a challenge. Half of respondents noted that fragmentation in approaches to IMM is a significant challenge, and 9% actually noted that this had worsened over the past 3 years, which also can be certainly a reflection of the proliferation of these tools or frameworks and other resources for IMM, as well as the corresponding kind of range of diverse impacts that investors are seeking to have. Other top challenges are in integrating impact management and financial management, and in transparency on impact performance, particularly around targets and results. So we gathered insight on these kind of progress points and sticking points, and also on opportunities to address these challenges, both at the practitioner and industry level, and really strengthen IMM practice going forward. So we see that these opportunities to advance IMM practice kind of fall into 3 main buckets. The first is around changing behaviors and norms around transparency and sharing impact data and results. Also around sharing common principles for impact investing. The second is around acquisition, use, and comparability of data. And then the third is around developing tools and resources, I think specifically those that really help integrate impact into decision making. So this data provides a useful baseline to show areas where we can collectively deepen our work. So I encourage you all to be thinking about what this could mean for your practice as well. And the positive thing is that progress in these areas is really already happening. So our speakers shortly will share their experience in this regard. First, I will turn it over to my colleague Lissa at Glasgo to share some of the GIIN's emerging resources to address some of these areas.
Great, thank you, Hannah. So just coming back to one of the findings you mentioned, I wanted to zero in on this selecting appropriate metrics piece and on one of the new projects that we are working on at the GIIN. Okay. So the GIIN is probably best known in the impact measurement and management world for IRIS, which is the catalog of generally accepted standardized metrics used by a majority of impact investors. But we realized over the past couple of years that historically the jump between impact goals and metrics was one that investors were struggling with, not because any of the metrics available were particularly bad metrics, but because that leap has not been particularly well supported. And that's one of the findings that Hannah just corroborated a moment ago. And so we set out to create a resource that would really help investors make that connection. And that involves diving into academic and field research, talking to a lot of investors, probably some of you on the call, about how they approach impact measurement and management, and essentially to do some of that homework behind making those connections based on evidence. And through that project, we developed Navigating Impact. And so the Navigating Impact project was developed by the GIIN with the support of USAID, the MacArthur Foundation, Rockefeller Foundation, JP Morgan Chase and Company, BNY Mellon, DFID, and Kellogg Foundation to help investors select evidence-backed strategies and adopt metrics that indicate performance towards those goals. And as you can see here, we developed it in consultation with a number of different industry experts, impact investors, standard setters, and others. And the site's in beta testing now, and we're actively soliciting feedback. But I just wanted to share here what's included and kind of how it works and how it might be useful to some of those who want to select the right metrics for the impact they seek. So I'll just walk this through with an example. So to date, we have organized the project around investment themes, and these are the three that we've developed so far. We have affordable housing in developed markets, and then clean energy access and smallholder agriculture in emerging markets. And we're also developing two others in partnership with the Social Performance Task Force and Results for Development Center for Health Market Innovation. So those will be coming up to be published fairly soon. And so as an example, let's say I'm an investor particularly interested in agriculture in emerging markets and interested most specifically in smallholder agriculture. So I'll just select that impact theme. And the site takes me to a set of strategies that are developed under that smallholder agriculture piece. And they represent different ways that an investor might think about their impact. So once an investor has selected an impact theme, they can use the resource to either just browse the strategies that are available, or they can select strategies based on desired outcomes and impacts that we found through the literature to align to them. So if, in my example, I am particularly interested in, let's see, wealth accumulation and standard of living, improving both of those, I might select those objectives, and it'll filter down to these three pieces. You'll notice that some of these strategies have some overlap, and they might be combinable, and we've designed that intentionally so that investors who have diverse interests can build the strategies that work best for them. And so I'll select this improved options for finance and savings strategy. And what that takes me to is a strategy page that provides four main pieces. So there's an overview of the strategy, and this is worked out according to the Impact Management Project's dimensions of impact. And it talks about just the key questions that investors might have about this particular approach. So what problem does the strategy solve for, and what's the scale? Who does it best reach, and where are they? What's the contribution likely towards shifting the problem, and how much of a change can an investor expect in this particular area? And it also provides a couple of illustrative investments that show what an investment in that strategy might functionally look like. The second piece is this evidence map that aligns the strategy to outcomes and impacts based on rigorous academic and field research that's already available. So we've outlined the citations of pieces that we've been able to find that support these particular approaches, and investors can use this to see where the evidence is strongest and where gaps still exist. The third piece is on core metrics, and this particular strategy has 7 core metrics that it pulls up that represent a strong starting kit for investors who are interested in this area or this strategy. And since we know that many investors want to quantify additional pieces of information, we've also created a subset of additional metrics that investors who are interested in a little bit more nuance may consider also adding to their impact measurement frameworks. And finally, we realize that while metric selection is great and very helpful, it doesn't necessarily help investors move towards actual practice. So we've pulled from all corners of the web a set of frameworks and data collection tools and case studies and other pieces that can help measure and manage towards those investor goals. And I've written a couple of the exact ones that come up on this one there, but there are additional ones as well. And these are just tools that can help put the strategy into practice. So I'll stop there, and I'll just note that we're actively soliciting feedback, both on the website itself and on additional metrics or resources that we should consider including. And those can be sent in via the feedback link on the website, and we encourage you all to check it out. Thank you. And from here, I'll pass it back to Kelly, who will moderate a conversation. Oh, no, to Hannah, sorry.
All done in. Fabulous. Thanks, Lissa. That was really great to to hear about some of these emerging resources to strengthen practice and address some of those opportunities like transparency and evidence-based and standardization as well. So we would love to bring these concepts to life by talking about the real experience of investors. So I'll introduce Will Morgan, Head of Impact at Sonen Capital, who heads up their impact practice and has really grappled with how to do some of this work across a diverse portfolio, including listed equities. And Michael Etzel, who's participated in some really important market development efforts, providing kind of a unique bird's eye view of the space, and has also been instrumental in developing from scratch an IMM practice that really considers evidence and results as well. So I will turn it back over to Kelly to kick us off with that. And again, a reminder to keep submitting questions in the lower left corner of your screen, and after this section, we will take Q&A. Great. Over to you, Kelly.
Thanks, Hannah. So to kick us off, I'm going to ask Michael and Will if you can start by briefly telling listeners a bit about the work you do to situate your remarks. Michael, let's start with you.
Thanks, Kelly. This is Michael Etzel here, joining you from Boston, partner at the Bridgespan Group, which is a global advisor to investors and philanthropists and mission-driven entrepreneurs focused on the practice of maximizing impact. We were spun out of Bain & Company about 17 years ago to offer the same type of advice and support that our colleagues do there to leaders in various corners of the social sector. Today, I lead our practice in impact investing that has us working with family offices and large institutional investors like Bain Capital and Texas Pacific Group across the spectrum from strategy development through sourcing, diligence, and portfolio management.
Thanks, Michael. And Will, can you talk a little bit about the work you do at Sonen?
Of course. Thank you, everyone. I'm happy to have the invitation to contribute today. Just very briefly, Sonen Capital is a dedicated impact investment management firm. We manage across asset classes on behalf of our clients, and we strive to deliver competitive financial returns alongside definitive, measurable social or environmental impact. We do this across public equity, fixed income, real assets, and now also a new strategy we've launched on alternatives or absolute return, just trying to find some high impact investments that aren't correlated with traditional markets. And as you can imagine, just a kind of a challenge to incorporate impact measurement across those disparate asset classes, but it's something we keep striving to do.
Excellent. Thanks, Will. And Will, I'm going to start with you. So as a head of impact at Sonen and as a thought leader on how to understand and use impact considerations for investment decision-making, as you said, across a variety of different types of strategies, you focus significant energy on tackling this impact question. And you talk about this, or Sonen frames this as sustainable investments are those that pass a positive screen, and thematic investments are those with a deliberate and clear impact thesis. So to provide a bit of context for the listeners, can you share a bit about what goes into the design of the various impact frameworks you've developed for the variety of investments that you make?
Sure. Yes, of course. So I think, Kelly, what you refer to as this bifurcation of sustainable investing and thematic investing is kind of a critical pillar for us, and something that distinguishes one investment from another. Really, sustainable investments in our lexicon is about how companies or how an enterprise conducts business, and that is increasingly able to be evaluated through a growing body of environmental, social, or governance data. Particularly in public markets, we refer to it as ESG data. And because investors are much more attuned to some of the non-financial dimensions of how a business is conducted, there's much more of that information available, and we can begin to use that to really qualify how a company conducts itself or how an enterprise carries out its business. In contrast, we see thematic investing really as what a company does, and that is the goods and services that it may produce, which could be things like renewable energy, power generation, or it could be computer chips which feed into the smart grid, for example. So there really is a difference between what companies do and how companies do it, and I think that's a critical first step to understanding for on the investor's part or the asset owner's part, what do we want to achieve? How could this be manifest through our investment portfolio if we consider about what companies do or how they do it? Just a brief remark on our motivations for kind of embarking on this distinction is it's reflective very much of the survey that Hannah just went over. The first thing is we want to better understand our impact, and secondly, we really need and want to report to our own investors what the impact of their investments are. So that's very consistent with some of your survey's other findings. I think also what is really our overarching motivation here is making sure that any investment we make in any different kind of asset class is really addressing what we think is most important. So if we're investing in clean energy, we want to understand why we're doing that, who will be addressed, and what the outcomes will be of such an investment. And that's true in public equity as much as in fixed income or in something like real assets. So really understanding what our investments are doing, how they're making such a contribution, we think is of critical importance.
Great, thanks, Will. And we're going to come back and kind of dig into this a little bit more in a minute. But first, Michael, as a partner with Bridgespan Group and with a variety of clients, like you mentioned, like Bain and TPG, who are interested in the impact of impact investing, and also as an active participant in many of the market-building efforts going on right now, such as the World Economic Forum's Action Agenda for Accelerating Impact Measurement and Management, you sit in a unique position to comment on both the day-to-day challenges that are facing impact investors and to make that sort of 30,000-foot observation of the market trends that could be shaping the way we do impact investing in the coming years. So with that, could you comment a bit about what you're seeing as some of the major market developments, specifically in terms of integrating impact into that investment process, and what you think are driving some of the rapid shifts these developments have instigated?
Absolutely. Thanks, Kelly, and appreciate the chance to share some of this, and we'll look forward to further discussion with the audience in a bit. Starting with some of the developments, really the way that I think about it does sit along the investment process in a lot of ways, starting with goal setting, right? I mean, the act of investment is difficult, right? Anyone who's a good investor will tell you that good investment is hard to find, hard to do, regardless of what your return expectations look like. And there, I particularly have seen a lot of value from the SDGs being part of the conversation in the last 2 years, really creating an authorizing environment for the goal setting and strategy development. It's not perfect, but it does give you a directional starting point to say, what are some things that matter, and at what magnitude might we hope to see progress by virtue of our investment? And there you're really talking at more of a fund level or a thematic level. From there, the next step then in the investment process, where I've seen a lot of bright spots lately, has been in the underwriting process, where, again, across a range of different investment areas, and to borrow from Will's framework earlier, more on the what companies do side of things, what does it take before an investment goes out the door to underwrite your assumptions about its potential future impact, just as you would underwrite your assumptions about its potential future performance. And this is, I think, a shift over time from an emphasis on more of the ex-ante measurement conversation, and why, even in the acronym of today's webinar, it's so important that we speak to both management and measurement. And just a few examples that many of you on the line are probably familiar with that touch on this idea of an a priori assessment. For those of you who listened in last week, you would have heard Michael Eddy from the Global Innovation Fund talking about their practical impact assessment, targeting a breadth of innovations reaching customers on under $5 a day income. Root Capital has advanced their impact efficient frontier for smallholder ag finance. We've been closely involved with the RISE Fund in deploying a rigorous evidence-based impact multiple of money for growth equity deals. And the IFC is in the process of rolling out its anticipated impact measurement and monitoring system that touches on both deal level and sector or industry level impacts before time of investment. So I'm spending more breath on this topic because I do think it's a particularly important piece of the shift in practice to the first step of the investment pipeline. And then lastly, one of the things that pops up a bit in the survey is the combination of integration of responsibilities and integration of reporting, where we heard this from all three of the panelists last week, again, Global Innovation Fund, Blue Haven, and Nuveen. There is some customization at the deal level going on most of the time, figuring out what the 3 to 5 key performance indicators are that touch on both financial performance and social performance, ideally in as integrated a way as possible. I don't think this takes away from some of those earlier steps of clear goal setting and accountability, but rather recognizes the reality that different investments, different asset classes require different signs of success. So moving on from those 3 points of goal setting, underwriting, and that KPI custom integration, Kelly, you asked this question of why. Well, I think there's a few factors that are pushing us in this direction, all of which stand on the shoulders of giants of practice, both within the impact investing industry and within some other fields that have been trying to make measurable progress on social issues for a number of decades. And I think it's a bit that sometimes we can take this as sort of a short exercise where the GIIN is, in the grand scheme of things, old but new. The field is old but new. There are some who have been practicing versions of impact investment for centuries, if you really want to track back, some for decades, some for years, and some for months. And within that, we're still in a relatively early stage of working across different asset classes and investment theses and trying to figure out what good looks like and what right-size rigor looks like for each of those. So what an early-stage, high-risk investor might need to underwrite their impact is going to look very different than what a late-stage growth equity investor needs to underwrite their impact, which again is going to look very different than someone doing a natural capital deal backed primarily by real assets. And this has been, I think, a call for a while now for some of that better industry-level segmentation. And I think what we're seeing as new actors and different scales and scopes enter the industry, that each is advancing the right practice for their context with the opportunity to continue to raise the bar across the field. And the challenge then to that, which pops up in the survey, are that we aren't really yet at a point where the market forces this. The motivations that are cited throughout the respondents here suggest that fundraising and donor investor requirements are 5th and 6th on their list of reasons for impact measurement and monitoring. And the number one incentive for impact measurement and monitoring, it comes from intrinsic motivation, both of investment teams and of investees. And then lastly, when you look at this set, 59% have some type of an impact target in place by way of accountability. So that's not meant to be a cast aspersions of the survey respondents, but it really does suggest to me that we're not yet at a point where there is a truly integrated set of market forces where both holders of capital, wealth holders, and investees and asset managers are all aligned against an integrated system here. And that's okay because we are in those early days still. But it does place a premium on keeping our eye on the ball of what is that bar of impact and how do we avoid the risks of impact washing that we've seen in other industries and other investment theses over the last 20 or 30 years.
This is really helpful, Michael. Thank you. And so, Michael, you just touched on a whole bunch of things. I'm going to pick up on one, but I'm seeing that some folks in the audience want to talk about a bunch of things you've just surfaced. And Will, I'd love for you to comment on this. So obviously, Michael just reflected on some of the market forces at work. And one of these things has to do with, motivations and intrinsic motivations. And I think implicit in that, it sounds like there's a point about it, sort of integrity, the integrity of impact investing, the integrity of the investment. I know, Will, you've grappled with this question of evidence. We just talked about that point in the survey, and Lissa just surfaced some work that's been done to sort of beef up the evidence to help connect investment strategies to metrics. Will, can you comment a bit about your use of evidence, what you're doing, but also some of the things that you're struggling with? And if you can comment in particular, just kind of picking up on what Michael said, just what does that actually look like when you think about the diversity of asset classes and themes that you work with? Are there any similarities? Are there any differences that you need to be considering?
Great, thank you, Kelly. And Michael, I appreciate your remarks in particular just about in some ways, the infancy of this field. It's been around for a long time, but in some ways it's very new. And I think this points to philanthropy too. And philanthropy has been trying to solve some very big problems for a long time, but I don't necessarily know if there is a consensus on what interventions are most successful and what kinds of things that philanthropy can do that would be most effective in addressing a specific issue. And some of the things that we have thought in the past are the panacea to solving poverty are in fact causing just as many problems as they may be ameliorating in some ways. And so I think this question about evidence is really central to how we all can be more effective. And I don't believe there is in center of gravity about what solution is most effective. Otherwise, I think many investment dollars would be going in that direction, and many of us would know about that. What I can say for our approach at Sonen is that we invest, as I said, across asset classes, but we also pursue many different kinds of impact themes, from clean energy and climate change mitigation to community development and small business development. And what we try to do for each discrete theme that we try to address through our investing is articulate exactly what we see as the most pressing challenges. So in the case of green real estate, where we invest considerably, we know that the built environment is the single largest source of greenhouse gas emissions. We also know that urbanization is taking place now at a faster rate than ever before, and that will only continue to intensify over the next 25 years. And we also know that affordability is a huge problem, not only here in the U.S. but across the world. And there's so much evidence that points to all of these phenomenon, and much of it is inarguable. We can observe it with our own eyes if we wish. So what we try to do is take a look at that body of evidence, what we see as some of the most pressing challenges, and ones that are not overly academic, but ones that, as I said, we can just observe with our own eyes and determine that some of these things must be addressed. And then we think about, if we agree that those things are the drivers and specific phenomenon are things that are making affordability a challenge and making the access to homes in urban environments even more difficult, we think about what kinds of investment strategies, what kinds of ways could we place our investment resources would be most effective in addressing and ameliorating some of those problems. And I think we try to imagine using that evidence, the empirical evidence that we observe, as a way to inform how we will make investments. And I think all of our strategies are published on our website. We articulate these things in very clear terms about what kinds of drivers we see, what kinds of outcomes we want to see, and how we will invest in order to start manifesting some of those outcomes. And I think time will tell. I think, I used the example of Lissa earlier that microfinance was thought to be the way that we were going to solve the world's problems with getting people out of poverty. It turns out, as investors flocked to that opportunity, it was actually creating a bunch of problems that many people didn't anticipate, and in some ways are more ugly than the poverty they were trying to alleviate itself. So I think that it's up to the investors to continue to monitor the outcomes and the outputs of these each of these singular and collective investments and make sure that the data and the impact data that's coming in is pointing in the right direction. And I think that's why the impact measurement and the management principles are so important, because that's the way we're really going to be able to assess our efficacy as we pursue these investments.
Great, thanks, Will. And we are getting a couple of audience questions in on this point, just digging into the evidence question a little bit more. Michael, I want to turn this over to you. Two things. Firstly, we do have a question about underwriting of impact, just kind of clarifying what that means in practice. I'm going to pause you there before you start. And then also, if you could comment a bit from your perspective on the state of evidence. So, I mean, the report shows that it's increasingly important, but there's some, questions as to just how much of a practice this really is. But also from your perspective, what are the risks to inaction on using sort of more transparent use of evidence, to the point that Will was just making about microfinance. So there's sort of two things there. Again, clarifying underwriting the impact and commenting on the state of evidence.
Sure. So starting with that underwriting idea, it's a bit of a translation from what we would do with most any type of investment on the financial side of the ledger, to say, what do we anticipate the performance to be over time? Now that's going to range pretty wildly, whether it's a venture capital private equity type of investment, a real assets investment, or something in the public equity space. But at the first level, the question is just, what is your process, what is your exercise for, at least internally, establishing a goal and finding then a way of holding yourself accountable to the performance against that goal. And knowing that in many cases you'll learn a lot, things will shift over time, but it forces a certain degree of clarity and transparency of thinking, much as you would see with the IRR process that is used, the internal rate of return, for measuring success in a lot of private venture capital and private equity investments, which again, just by way of context, is a relatively new practice. It's a tool that was translated out of engineering project finance in the 60s and 70s into what was then the brand new industry of venture capital and private equity as we know it today. So in that grand scheme of history, this thing that is such a dominant tool and that we take as a dogma of investment is actually relatively new. And I think the question that we're asking now, and that I'm suggesting a bit by even using that phrase of impact underwriting, is what's our equivalent when we start to think about impact? How do we put a goal on the table, simplify a bunch of assumptions, and use that, both as Will suggested, tied into the evidence for thesis development, and use that in the management of individual investments? So happy to turn from that to the second question, Kelly, on more of the state of evidence. And I think there's a couple of strands on this, and I'll share an example. The two strands are what does it take to make evidence useful to the investment community? I've spent a bunch of time poking around in this world, and one of my colleagues discovered that there's something on the order of 2 million academic research studies published any year. Now, it doesn't mean it's 2 million good academic research studies published any year, but it just gives you a sense of the sheer volume and flow of information that for those of you who spend time in that corner of the world or who are familiar with the What Works movement, no, it just doesn't really speak investor. With good credit to the GIIN team for doing some of that translation in a couple of those industry verticals. You need to find a way that ties this to investable areas, investment theses, and specific outcomes or indicators that can make some of this information more accessible to the investment community. I think that's one big step forward that a lot of folks will need to think through over the coming years, to say, what does it mean for this to be translated? What does it mean for me to use this? Because the second strand is then to what end? How actually do you use it? When you have a good report, when you have a good synthesis, when you have a good summary, how do you manage these indicators? How do you integrate them into your decision-making processes? Again, building on the finding in the study that in most cases this impact measurement and monitoring system is integrated into existing practice of investment responsibilities. there's this question then of how do you bring evidence into that in a consistent and parallel fashion. And there's also a bit of a watch out that I think Clara Miller, the outgoing president of FB Heron, nicely summarized in one of her letters last year, which is how do we as an impact investing industry avoid some of the less desirable behaviors, and she may have used stronger words, but I don't have the letter in front of me, of philanthropy when we think about using evidence and when we think about gathering data. Because there are some skills and assumptions that exist among the community of investment professionals about simplifying large sets of information, making assumptions to inform decisions, but acknowledging that while that is a rigorous process, it is rarely right. Again, back to the IRR, when you set an IRR target for a deal, you never hit it on the nose. It's always a bit off, above, below for a bunch of different reasons, but it is a simplifying assumption and way of communicating that to the world. So that those two steps of how do you make evidence useful and then how do you translate it into your resource allocation process are both really important. And there are some bright spots, some of which show up in the resource that the GIIN team was highlighting earlier. By way of example, if you're working in the health space, you have the benefit of the World Health Organization, of the Institute for Health Metrics, which is a Seattle-based research shop that the Gates Foundation has invested philanthropically more than $500 million in, purely on metrics and better data, just to give you a sense of how complicated some of these questions are. And there you'll find things like the disability-adjusted life year as a good quantitative proxy for the magnitude of health impacts. Similarly, if we talk for those of you who are investing in the environment about the social cost of carbon, we can argue today about whether that should be $300 a ton or $60 a ton. And really, the debate is context-specific. We're not actually debating the social cost of carbon as a metric anymore. 15 years ago, that didn't exist. We would have been debating the metric even in and of itself. So there are moving targets and outside actors here that are also helping advance this discussion well above and beyond the scope of the impact investing industry that gives a sense of the magnitude of the opportunity to connect to that richness of data and evidence.
Thanks very much, Michael. And this is surfacing a variety of questions. So we've been obviously focusing on existing evidence, the pros and the cons, the opportunities and challenges. So we have several listener questions about kind of thinking now about new data, so data collection for new information. Will, I'd love to turn this question to you. Can you comment on how you actually collect new data and how you use this information, to Michael's point, in decision making? How does that work? And if you do anything differently because of what you learn, that would be particularly interesting as well.
Sure. I think it's a great question, and I'll be brief with my response just to keep it simple. But, I made an earlier remark that the practice, in my view, of impact evaluation, impact measurement, and management varies wildly between different asset classes. So with respect to public equity, we can gain access to a mountain of ESG, environmental social governance data, which I believe is reasonably accurate, and there's many different ways to kind of toggle it around and manipulate it to test how it may fit with an impact thesis. Where I think that's probably more germane to the audience is investments where you can actually specifically invite the investee to report on very specific indicators. And in that case, I think there's a greater chance for uniformity and for aggregation so we can see what's happening at the portfolio level. But in that case for us, when we invest into any enterprise or fund or whatever it may be, we have a very explicit arrangement going into the investment that we are going to collect specific impact data for very specific key performance indicators, much like Michael mentioned earlier in his remarks. And I think that's essential to enter into a relationship with the expectation on both sides that very specific data will be provided at very specific intervals. And I think that has helped simplify the process for us, and it also has made the process a lot less of a headache because everyone knows the expectations going in.
Excellent. Thanks, Will. And Michael, we have just to kind of continue to dig into this data question, we have a couple of listeners who are interested to hear your perspective on It seems like there's a barrier for not only collecting data, but also being more transparent about what we know and what we don't know, what's working and what's not. Do you have any thoughts on how we should encourage transparency in data sharing? And you mentioned, I think you made a point around impact washing. So if you have any thoughts about how we might prepare for examples of impact washing we're bound to encounter, that would be particularly interesting as well.
Sure. It's a complicated question that I don't know I have the answer to, but I have a few ideas. And it takes me in two different directions. One is the more academic research where, just using venture capital as an example, Josh Lerner and his team published a landmark report back in 1999 that was the first time that anyone had really looked at an anonymized set of venture capital returns. It was the venture capital cycle. And it was a real breakthrough to say, whoa, wait a minute. Now we know what the return distribution is for venture capital. And I don't mean to say that by way of obsession with financial performance, just by way of illustration that some really good deep research with broad-based data can make a big dent in our collective understanding of what's going on with the world. On more of an ongoing basis, which I suspect is sort of both the real challenge and the real opportunity for the industry, a simple step forward would be aligning more universal and consistent demand from the asset owner community, whether you're talking about the universal owners that basically have to buy a little bit of everything, the big mega pension funds, or some ultra high net worth individuals and single family offices who may have a high degree of influence and ability to shift behavior among the GP or asset manager community. Really tapping that audience is something that I'm particularly curious about because that's where some of this demand for consistency could come from in the future. I haven't seen as much of that today, but it might be a path forward.
Thank you very much. This has been a really incredible conversation. I'm just taking a quick note at the time. Will, I want to give you one the last question here. If you could comment on, I mean, obviously progress is exciting. We talked about this in the report, a bit of progress points in the report. We've highlighted some challenges and pros and cons. In terms of some practical considerations that you might have for those in the audience just getting started in this rapidly advancing practice, what would be some of the top line things you might share?
Sure. Great question, and I'm fairly impassioned on this, and Michael actually already made a very similar comment. The first is, and this seems so rudimentary, but I think the most critical element is to really understand what, as an asset owner or as an investor, what you would like to accomplish, and very specifically articulating what an outcome would look like that you would be satisfied with. With that in hand, it's so much easier to go about the rest of the process about selecting investments, underwriting them, and asking for specific impact reporting. It's very hard to do after the investment has been made to try to pigeonhole an investment into your thesis. So I really think just be very clear about what you want. Michael then mentioned the idea of 3 to 5 KPIs, key performance indicators. I think that's perfect. I think oftentimes we are seduced by the idea of collecting a whole bunch of information and trying to figure and make sense of it all. I actually think, on the contrary, with the impact thesis in mind, the outcomes that you envisage in mind, it's pretty easy to use 3 or 5 indicators to collect reasonably good data to speak to how well that thesis is being borne out. And to keep it simple, 12 pieces of data is too much. 3 to 5 I think is manageable. I would imagine Michael would agree. What do you think, Michael?
Absolutely.
Fantastic. Well, we are at time. I'm going to turn it back to Hannah just to close us out and thank everyone.
Thank you, all three of you, so much. And thank you, of course, to everyone on the line that submitted questions. I know we really only got to kind of graze the surface on some of these really rich topics. So I encourage you all to reach out with further comments or questions. Also, again, to consult the GIIN's Knowledge Center for further research and the IRIS IMM website for some of those resources like IRIS, of course, and Navigating Impact. And then, again, there are many opportunities to contribute your perspectives to research like this. Our annual survey data collection is open through the end of the week, so please do reach out to me if you're interested in participating in that. And then again, a big thank you to our speakers on the line, Will, Michael, Kelly, and Lissa, and thanks so much to all of you for joining as well. And hope it was a great start to your week. Take care, everyone.
Please stand by.